Today I'm speaking with Nassim Taleb. He has influenced me perhaps more than any other thinker. I discovered his work when I was quite young, at the end of 2016. I read his books out of order. I finished with Fooled by Randomness, and I started with The Black Swan.
That's the correct order.
The Black Swan was the book that got me hooked. For me, that book was not so much about black swans as about what Nassim calls the platonic fold. And this year I've had the pleasure of meeting him in person. He has a certain magnanimity. He's been very kind to me. So it's an honor to have him on the podcast. Welcome, Nassim.
Thank you for inviting me.
So naturally, I have many questions. And I guess the theme of my questions is probably best summed up by the title of your technical book, The Statistical Consequences of Fat Tails. But I'd like to start a little bit abstract and then get more and more real. So first question, it only takes one black swan to know that you're in Extremistan. But if you're in a particular domain which has yet to experience a black swan, how do you know whether or not you're in Extremistan?
So let's not use the word black swan
and
use extreme deviation.
All right.
Black swan is something that carries large consequences. It tends to happen more easily in an environment that produces still large deviation. So what I call Extremistan.
Mm-hmm.
So let's ignore the terminology black swan here because it may be confusing. And let's say that the following asymmetry, discuss the following asymmetry. If I am using a thin-tailed probability distribution, let me say, I can be always surprised by an outlier with respect to my distribution, a large deviation, you see, that would destroy my assumption of using that distribution. If, on the other hand, I'm using a large deviation model, or a model that the Extremistan model, the reverse cannot be true. Nothing can surprise you. A quiet period is entirely within statistical properties, so is a large deviation, which is why you have to assume that you're in the second class of models unless you have real reasons to a real robust representation of the world to rule it out.
Right.
Like, for example, we know that with height that you're from Australia. Even in Australia you may run into someone who's 2 meters 40 centimeters tall, but even in Australia, they don't have people 5 kilometers tall or 500 kilometers tall.
Yeah.
Why? They are biological limitation. The person needs to have a mother. See, if you use a maximum entropy representation, the Gaussian is the maximum entropy distribution with known mean and variance. So you're bounding the variance. You see? If you're bound the variance, it's the equivalent of bounding the energy. So you see what I'm leading at. You can't have unlimited energy. So you know that a lot of mechanisms have these physical limitations.
Right.
You see? So you can rule out based on knowledge of the process, biological understanding, physical understanding. But if you don't know anything about the process, or the process is in multiplicative phenomena, such as contagions, pandemics, or simply processes that don't have a limit to their movement. Like, for example, a price, you and I can sell, buy from one another this at $1 billion. Okay, there's no limitations. There's no physical limitation to a price. Therefore, you could be an Extremistan and you cannot rule out a thick-tailed distribution.
Right. So what you mentioned height as an example of a Gaussian process.
Yeah, or actually pseudo-Gaussian, so more like normal, but with low variance. Yes.
Sure.
Because it's bounded on the left.
Yeah. Okay. So what are some heuristics you use to judge whether you have a compelling reason to believe that something has a Gaussian process?
It's not a. I mean, you see it when you you know it when you see it.
Okay.
If we're talking about weight, height, such phenomena, then you can rule out extremely large deviation.
Yeah.
Not completely, but those deviations that occur are still going to be acceptable. In other words, you may have a 5 meter tall human with some kind of deregulation, hormonal deregulation, or something like that, but you're not going to get a 500 kilometer tall human.
Yeah.
In finance, you can't rule out the equivalent of 500 kilometer tall or 5 billion kilometer tall person.
Yeah. Okay. So basically, you need to couple the absence of extreme events with some kind of very compelling explanation as to why the data is being...
Explanation that rules out these deviations based on either energy or more knowledge of the physical process.
Yep.
The generator is physical, after all.
So it's interesting that not only do power laws appear everywhere in the natural and social world, but perhaps certain tail exponents appear to be intrinsic. So last week I was chatting with your friend and collaborator, Raphael Douadi, and he mentioned that he has this view that the tail exponent for financial markets seems to be 3. And
he's wrong, but that's Raphael. All right. There was a theory of why it was. It's called the semi-cubic theory.
Okay.
That he is following, and someone figured out that the tail exponent for company size, the style of companies, was 1.5. So therefore, their orders are going to impact the market. Hence, by using a square root model of impact, in other words, where the quantity impacts the price following some kind of square root effect. Okay, then you end up with markets having what they call the cubic, going from half cubic to cubic signal. It is a nice theory, but I think the tail exponent in financial markets is lower than that from experience.
Mm-hmm.
And I don't like these cute theories because the distribution of concentration is not 1.5 half cubic. With technology, it's much, much higher.
But you also see it in other domains, like a lot of people have commented on the fact that city size seems to have...
I would not get married to these exponents.
Okay. Is that because there's always the possibility of an even more extreme event to kind of screw up the exponent?
Or less extreme event. I mean, coming up with an observation that's very noisy and generalizing to a theory of cubic or half cubic, and there used to be a square law and a lot of things. I mean, it's a very noisy representation.
Right. Okay, so I have a couple of questions about finance. How long before 1987 did you realize that volatility shouldn't be flat across strike prices for options? And how did you realize?
I mean, I saw deviations, all right? And I realized, and I had, an unintentional reward from having a tail exposure. So I realized that I said, okay, you don't have to be a genius to figure out if the payoff can be so large as to swamp the frequency. So I think that I was pretty convinced by September 1985, after the Plaza Accord, when we had a 10 sigma move. At the time, we didn't have access to data like today. But but we saw prices, and I noticed that effectively you had a higher frequency of these very, very large deviations across stocks. I mean, you had mergers, you had stuff like that. So it was obvious, and then therefore the Black-Scholes, or the equivalent Black-Scholes, they call it Black-Scholes, but Black-Scholes didn't really invent that formula. They just justified it. The formula is from Bachelier and others. and a collection of others who rediscovered it or repackaged it differently. That you needed to have a higher price for tail options. So I got in the business of collecting tail options. But one has to be pretty blind not to see that you have winner-take-all effects in finance, which is not compatible with a Gaussian representation.
Right. Yeah, it's pretty crazy how blind so many people have remained to that observation. So your books have become very famous. Universa has done very well. Mark Spitznagel has also written books which have sold well. Why hasn't the tail hedging strategy now been fully priced in by markets?
Because of MBA lecturing, modern portfolio theory, because people get blinded by theories, and also because if you're trading your own money, you're going to be pretty rational about it. If you're dealing with the institutional framework, you need to make money frequently. And the trap of needing to make money frequently will lead you to eventually sell volatility. So there's no incentive to buy volatility for someone who's employed, for a finite period of time in a firm. No incentive.
Right. Yeah. Are there any markets that do price in convexity?
They all do in a way, but it's they don't know how to price it.
Right. Interesting. So I have a question about venture capital, but it perhaps has broader applications. There's a kind of inconsistency I noticed. So on the one hand, as a consequence of the power law distribution of returns, one recommendation to, say, public market investors is they may want to pursue a barbell strategy, which you've written about. So say you have like 90% of your portfolio in very safe things like bonds, and then with 10%, you can take lots of little speculative bets to maximize your optionality. The same logic could also be pursued by, say, book publishers, where you might want to take, because the success of books is power law distributed, you might want to take lots of little bets to maximize your chance of publishing the next Harry Potter. On the other hand, I've heard venture capitalists say that a reason from the exact same premises, the power law distribution of startup success, but come to an opposite conclusion, which is that they want to concentrate their bets really heavily in a handful of companies.
Because, the way you need to look at venture capital is that it's largely a compensation scheme. Largely like hedge funds, compensation scheme.
Okay.
Compensation to
the 2 and 20.
The mechanism. So they don't make their money, venture capitalists, they don't make money by waiting for the company to really become successful. They make their money by hyping up an idea,
okay,
getting new investors, and they're cashing in as they're bringing in new investors. Which, it's plain. Look at how many extremely wealthy technology entrepreneurs are floating around while not having ever made a penny in net income. See, so the income for venture capital comes from a greater fool approach.
Okay, so a Ponzi kind of dynamic.
Not necessarily Ponzi, but you're selling hope. You package an idea, it looks good, so you sell it to someone, and then they have a second round and third round. They keep it around so you can progressively cash in.
Got it.
It's not based on your real sales.
Okay.
Or your real cash flow, particularly in an environment of low interest rates, where there was no penalty for playing that game.
Do you think there's any skill in VC?
They have skills, but most of their skills are in packaging,
not for the things people think.
Exactly.
Right.
Packaging, because they're trying to sell it to another person. It's a beauty contest. The
Keynesian beauty contest.
So they package a company and look at the compensation of these venture capitalists.
Right.
You can see it. You have either you have financing rounds where someone cashes in at high price, or you have an initial public offering. So I come from old school finance, where you haven't really succeeded until the company gets a strong cash flow base.
All right, so I have some questions about behavioral economics and empirical psychology. Behavioral economics.
Yeah, I thought that was the center. Yeah.
Well, I'm not a behavioral economics podcast, but I do have a lot of questions about this. So, first question: if I take the Incerto chronologically, you seem much more sympathetic to empirical psychology and the biases and heuristics research program in Fooled by Randomness, and at least by the time you get to.
So let me tell you the secret of Fooled by Randomness.
Okay.
I wrote Fooled by Randomness, and it became very successful at the first edition. And it had no references. And it had no behavioral side, just like aside from how humans don't understand probability. Minimum of that. Then I met Danny Kahneman in 2002.
In Italy.
And then, I spoke to him. He said, you don't have a lot of references for stuff like that, and a lot of comments. So I said, no problem. So I went and I got about 100 books in psychology. I read them over a period of, say, 6 months. Went through the corpus, everything, figured it out. They think that their math is complex and math is trivial and wrong. And then I cited, and I remodeled the prospect theory, because prospect theory itself, because it is convex concave, right? It tells you itself that you're, you should take, if you're going to lose money, you take a big lump. It's more effective to make money slowly, because people like to make $1 million a day for a year rather than 250 million and then nothing. Okay,
right.
But it's a reverse for losses, and there are a lot of things in it that's correct. So I like that aspect. So anyway, I start putting references on sentences I've written before, not knowing anything about it, which was not the most honest thing, but it was to link my ideas to that discipline.
Right.
It is. It's not like I got the idea from these books. I got the ideas and then found confirmation in these books. Then I met Danny from the very first time. I told him, your ideas don't work in the real world because they underestimate people in the real world. They underestimate the tail event, whereas in your world, they overestimate it. But there's a difference, that in the real world, you don't know the odds. And you don't know the payoff function very well. In your world, you know the odds and the payoff function. So he liked the fact that I gave him a break in that sense and still used his prospect theory. Because the idea that losses are, and the loss domain is convex, I like the idea. But by then, I knew enough, about the psychology literature and about all these decision-making theories, So by then, I built myself a knowledge of that. I revised Fooled by Randomness. I put a section in the back, connecting my ideas to that literature. And then they started liking it in the world. Brother Chiller didn't like it. He said, you had a great book. It was genuine. Now you have an academic tome. That was Schiller.
Right.
Okay. But the other people liked it.
Yeah.
So that was my first encounter with him, was on prospect theory, which I believe is correct for that function. Okay. But not necessarily for the rest of the the underestimation, overestimation of probabilities in decision making for reasons that I show here. Because you never have a lump loss except with lotteries. Typically, it's a variable, and there's no such thing as a typical large deviation.
Right.
You see, it is technical, but maybe your viewers will get it better with an explanation. We'll get there next.
Yeah.
And then I started looking at stuff done in behavioral economics, such as the Benartzi-Taylor. The Benartzi-Taylor assumed that, so I thought it was a mistake. Benartzi-Taylor assumed, Gaussian distribution, and then explained why people prefer bond to stocks. That was the idea at the time. And I said, no, maybe it's right. And then therefore it was irrational. They went from the standpoint as irrational to not have more stocks, given the performance. But I tell them that the risk is not the one you see. See, you have tail risks that don't show in your analysis. I told Taylor said, well, assuming it is a Gaussian, then my theory works. I say, I'm not assuming, assuming the world were coconut, a lot of things would work. So the world is not a Gaussian. But you're recommending that for 401k and stuff like that. So then I noticed that's the first mistake in Taylor. There are other mistakes in that discipline, like this idea of rationality.
Yeah.
And to me, rationality is in survival, not in other things. And I discovered, then I spoke to smart people like Ken Binmore. I suppose when you speak to smart people, you realize these people are not making the claims that are, that are common in that, I'd call it industry in that field.
Right.
For example, there are things that are deemed irrational, such as, let me take a simple example. The people use as a metric, and it was not contested, the transitivity of preferences. That I prefer apples to pies to say bananas, all right? Okay, but then bananas to apples, all right? So you're violating transitivity of preferences. But I said, no, maybe that's not the way the world works. If I always prefer apples to pie and I'm presented that choice, nature wants to make me eat other things, and also wants to reduce the stress on the environment of people always eating the same thing. So it's a good way for nature to make me vary my preferences, either to protect nature and to protect myself.
Right.
So it's not necessary, that transitivity of preferences is not a necessary criterion for rationality. And it's a way nature makes you randomize your choices, for example, for a broader. So that's one thing. So if I were to structure this conversation about the defects of behavioral and cognitive sciences as linked to economics and decision theory, we have things linked to misunderstanding of probability structure and things linked to misunderstanding of the dynamic aspect of decision making, what we call ergodicity.
Right.
So let's put them in these two. Let's use these categories. So we have the equity premium bias comes from equity premium, the fact that people don't invest. Their explanations come from poor understanding of probability structure. The aspect of prospect theory that is wrong comes from misunderstanding of probability structure. Is that if you have an open-ended distribution with fat tails, then you don't have the same result. The idea of what's the other idea is the fact that people, if you give them 10 choices, the 1 over n Okay,
Mm-hmm.
1 over n is optimal under fat tails.
Right.
But so this is again, I think Thaler has 1 over n papers saying that you should reduce people's choices because they spread them too much.
Mm.
But that's an optimal strategy. There's another one about probability matching, where you think that probability matching is irrational. Probability matching means that if something comes up 40% of the time and something comes up 60% of the time, that you should invest 100% of the time in the higher frequency one. But in nature and in animals, but also humans, do probability matching. And when you write the math using entropy, like in this Kelly style modeling, if I have 10 horses and I got to allocate among the 10 horses, if I want to maximize the expected return, how do I allocate? In proportional probability of when. So these are the errors linked to probabilistic structure. There's another one also. There's intertemporal choices.
Mm.
Like if I tell you, do you want a massage today or 2 massages tomorrow? You're likely to say, okay, 2 massages tomorrow. Or let's assume that you, when facing this choice, you take the 2 massages tomorrow, then not 1 today. But if I tell you in 364 days, you have the choice of 1 versus 2, you see, you would reverse. No,
Yeah.
you're possibly actually. Let's say that you have it the other way. That you take 1, the 1 today rather than 2 tomorrow. But you reverse. That's not. If you use a different probability distribution, or different preference structure.
Right.
Plus, there is another one that. How do you know the person offering you that bet will satisfy it tomorrow? You see, as I say, the bird in the hand is better than
right
than some abstract one in a future on some tree. Okay, so if you say the person is full of baloney, all right, maybe full of baloney, I'd rather have 1 today. Okay, let me take it today, or he may be bankrupt. But if he is 364 or 365 days, the effect is not that big.
Yeah.
So it depends on what kind of preference structure you have, or what kind of errors you have in your model. So this is the first class, misunderstanding of probability, and we can go on forever. The second one is more severe, misunderstanding of dynamics. Like we had a Twitter fight with Thaler while running a Ruri, where he couldn't understand why you can refuse a bet of 55%, win versus 45% probability of losing. That someone can refuse such a bet and be rational. Okay, well, number one is to realize that, of course, you can refuse such a bet because you got to look at things dynamically.
Yeah, if you keep taking those bets, you'll eventually blow up.
I take risk in life of that nature all the time.
Yeah,
you see, so, and it would bring you closer to an uncle point.
Yeah,
I could probably do it for $1, but maybe not $10 or not $100. That's certainly not $1 million.
Yeah,
see. So he couldn't understand the ergodic thing, and that's the Kelly criterion shows it clearly. But Kelly criterion is just one example of getting that result without optimizing for growth. My whole idea is surviving. It's simple, like saying, hey, you know what? The trade-off of smoking 1 cigarette, look at how much pleasure you derive versus how much risk you're taking. So it's irrational. So yes, but do you know people who smoke once? You got to look at the activity, not an episode. And he couldn't get it. That's one example. There are other similar examples. Oh, let's talk about mental accounting.
Mm-hmm.
I think he started with mental accounting, Thaler. And he finds it irrational that, say, husband and wife have a joint checking account. The husband visits the department store, sees a tie, doesn't buy it, it's too expensive. Goes home and then sees this gift and got all excited that he got it from his wife for his birthday. Okay. So, that mental counting is irrational. I say, yeah, but how many birthdays do you have a year? Okay.
Yeah.
So it's not frequent. So, so this is where, you got to put some structure around the mental accounting. Another mistake he makes, the last mistake, the mistake is that it's irrational when you go to a casino to increase your betting when you win money from a casino. That's mental accounting. That money won from a casino should be treated from an accounting standpoint the same way as money that you had as an initial endowment. Okay. Yeah, but think about it. If you don't play that game, you're going to go bankrupt. This is what we call it, called playing with the house money.
Mm.
So it's not irrational. So practices that have been around for a long time are being judged by that industry. I call it an industry because it became an industry, just producing papers. And they don't have a good understanding of the real world. So, and not a good understanding of probability theory.
Mm.
So this is why we shouldn't be talking about them. And actually, I hardly ever talk about them anymore. I mean, I discussed them initially when I went in and found effectively, yeah, we are fooled by randomness, but not in the way they think.
Yeah.
And they are more fooled by randomness in other areas. So let me pull out of this. So I pulled out of this, but in my writing, I hardly ever discuss them.
Yeah. At least, I guess, like distinguishing empirical psychology from behavioral economics, my quick take on empirical psychology is that a lot of the heuristics that, say, Danny and Amos found are actually descriptively pretty good approximations of how humans think. But the problem was the additional step they took of then labeling those as, the use of many of those heuristics as irrational against their normative,
actually
their
don't
normative
quite
benchmark.
Use the word irrational. They
were careful. They were careful with that.
But they still indirectly use it. It's
right.
only because they had a war with some
Gigerenzer.
After the I think was it the not Lisa paper, the one with the bank teller, was
Linda.
The Linda problem, yeah.
Yeah.
They had a lot of problems with philosophers who, and then they avoided the use of the term, in the whole industry, the term rationality.
Right.
But effectively, they find it is not something rational, but they don't use the word rational.
Yeah.
Okay, but you forget a few things. That one, I had that a lot of people in the advertising industry knew these tricks,
mm-hmm.
And then also even in the psychology literature, a lot of things had been done, but their mark is to show how decision making by human is messed up. It's like what Tversky said, I don't specialize in artificial intelligence, I'm into natural stupidity, all right? But effectively, they are the ones who are stupid. I mean, people in that industry, not humans. I mean, we've survived doing these things. And also, there's the school of Gigerenzer, who finds, that these heuristics are
ecologically rational.
Are rational, but you don't have to go out of the way to show that these things are rational. I just don't want. My problem is that I don't want the practitioners of that field who barely understand probability to get anywhere near the White House.
Yeah,
and we dangerously came closer. Yeah, but we were during COVID. I mean, first, remember that we had Cass Sunstein, who to me is about as dangerous as you can get what I call, actually, I wrote IYI, the intellectual yet idiot, based on him and Taylor, right? Because I knew Taylor well. Sunstein I met once, but it's sort of kind of thing that sort of like instant revelation. Oh, that he is it, right? The way they reason, okay? And so we had these people advising initially against reacting to COVID. Again, misunderstanding the probability. Why they say, well, this is the empirical risk, and the risk of Ebola, is very low compared to the risk of falling from a ladder.
Yeah.
They were on it. And
I remember
this is
that
when I started
article.
the war against them. That was before, and when COVID started, Sunstein was advocating. Was advocating ignoring COVID because he said, look how the risks are low. He mixed a multiplicative process with an additive one.
Mm-hmm.
And by the way, now if you ask me to figure out the difference, is for me to get fat tails via multiplicative processes.
Mm-hmm.
Not all fat tails come from multiplicative processes, but but multiplicative always generates some kind of either log normal or fat tail. But log normal is very fat tailed, by the way.
Yeah.
And at high variance, it acts like a power law.
Right. Whereas at low variance, it acts more thin tailed.
It looks at low variance like a Gaussian.
Yeah. It's strange, isn't it?
That's log normal. There's an Australian person, I think his name was Hayek, who spent all his life on a log normal.
Oh, really?
Yeah.
Are there examples in the real world of log normal distributions?
Yeah, of course. There was a big dispute between Mandelbrot and the anti-Mandelbrot, saying that from Gibra looked at wealth. But what happens with the thing when you start multiplying? You see, you get a log normal,
right?
Naturally.
Oh, okay.
So what the way it's technical. Sorry,
no, technical is good.
Yeah, technical. So if I take a Gaussian distribution and take the exponential of the variable, you see, because you know that the log is additive, right? Okay. So when you multiply, so you take the exponential, you get a log normal distribution.
Mm-hmm.
Log normal distribution, and the mu and sigma of log normal distribution are preserved.
Right.
They're not the mean and variance of the log normal. They're mean and variance of the log of the log normal.
Okay.
It's misnamed. It should be the exponential, but there was another name called exponential for another distribution.
Okay.
Right? So Gaussian, you exponentiate, you get log normal. Now, there's a distribution that's thin-tailed, but slightly fatter tailed than a Gaussian. Barely, all right? The exponential, the gamma, you know that class.
Mm-hmm.
Okay. You exponentiate, what do you get? A power law.
Huh.
You see? So you're so which one you're exponentiating? Your base distribution needs to be Gaussian for you to end with a log normal.
Right.
Or fatter tail than a Gaussian.
Okay.
And the next class is a gamma, or the exponential, and you get a Pareto.
Right. Yeah.
And then of course there's an exponential of a Pareto. It's called log Pareto.
Okay.
And here, as they say, no longer in Kansas. You're not in Kansas anymore.
This is a little bit above my pay grade, but it seems to make sense. So, just a couple of final questions on behavioral economics, and then I want to move on to some other stuff. Which results in behavioral economics do you think are robust? We've spoken about the loss. Do they call it the asymmetric loss function in prospect theory? Is there anything else?
No. No.
Nothing else.
Let me think about it. I think that we know a bunch of things that are part of that school, but they're not central to it. Like, for example, how people react, framing, how people react based on how we present things to them.
Mm-hmm.
A lot of these things work, but whenever they make a general theory with a recommendation that connects to the real world, they get it backwards.
Right.
I took Thaler. I told you, Thaler, all his papers, okay, you interpret them backwards. If he says, okay, you should have a concentration, okay, an optimal concentration of stock, you go over 1 over n.
Mm-hmm. You saw my podcast with Danny Kahneman last year.
I did not see it. I just
So
read
you saw the
segment,
excerpt.
the segment where he said that he accepted that. He said it publicly, but he had told me privately, yeah, I agree. It doesn't work under fat tails.
It turned out to be one of his last podcast interviews. What did you make of his answer? I mean, obviously you already knew the answer, but
he made it public.
He made it public. Yeah.
He said in Taleb's world, I'm talking about the real world, so I don't own the world. I'm not
in the world you live in, which is also the world exactly, the rest of us live in. Yeah. But it showed great integrity.
It shows integrity is, it shows also, it shows realism, and it shows also he didn't want to upset me because he was always scared of me going against him.
Oh, okay.
See?
Right.
Even
though he's not on Twitter.
Definitely, one thing about him is I'm certain that he knows everything that was said about him on Twitter.
Oh, okay.
I'm saying he doesn't believe he should be up there, but I'm saying he's normal. He himself would tell you I'm normal.
Yeah.
I told him, why did you write a book if you know that you have a loss aversion? In other words, one bad comment hurts you a lot more than a lot of praise. He looked at me and said, I shouldn't have written a book.
That's funny.
Yeah, I don't have the same loss aversion, right? I don't mind. I have the opposite function.
Oh, really?
Yeah,
I thought
a little bit of praise from people.
Yeah.
All right, is for me is offsets pages of hate.
Oh, interesting.
Yeah,
but you definitely have. I assume you have loss aversion in other aspects.
No, of course. Yeah, but it's not the same kind of loss aversion reputationally.
Got it. Yeah.
You see, that's my idea of anti-fragile.
Right.
Because I didn't start as an academic. I started in the real world.
Yes.
Look at it now. I started when Gaza started. I felt honorable to go in and defend the Palestinians when nobody was defending them. It took a while for a lot of people to jump on that train. And in the beginning, I had probably 15 people attacking me for every one person supporting me. And now, of course, it has switched because maybe they found it less effective to attack me. They can't intimidate. People tend to attack those who can be intimidated. So there's this sense of honor, that sometimes makes you feel rewards from saying something unpopular or risky.
Right. Worry about integrity, not reputation.
Yeah, as you advance in age, you go back. If you're doing things right, you go back to your childhood values. You see, your childhood values, were about honor and taking a stand when needed, and then you continue. And every time I take a stand, I feel it's existential. I feel I've done something.
Right.
When I'm saying that Danny doesn't have the same representation, and someone complained about him among his circle of friends jokingly, he said, for me, happiness has different value. For Danny is eating mozzarella in Tuscany. That's his idea of, it's hedonic.
Right.
Hedonic happiness.
Hedonic, yeah.
So therefore, he analyzes everything in terms of hedonic treadmill.
Yeah.
But I'm sure deep down, Danny was not like that.
Right.
He realized that was, not what what life was about.
Yeah. It's more about goals and
maybe, but he was,
and values.
but he was an atheist. You know that. And the first time I met him, he ate prosciutto. I told him, prosciutto. He said, "There's not a single religious bone in my body." So then I realized that it's a different customer.
Right. Yeah.
And when you're not religious, there are a lot of good things, but there could be bad things. Like you're too materialistic about your view of the world, and you're coming here to maximize mozzarella and prosciutto. It's very different.
Yeah, it starts to taste a bit boring after a while. So if your sympathy towards biases and behavioral economics was something you changed your mind about, are there any other big things in the Incerto that you think you got wrong or you've changed your mind about?
No, I didn't change my mind. I mean,
okay,
if you know, go reread the Fool by Randomness.
Yeah.
Read it.
I mean,
and you'll see that there's nothing. It's just I changed my mind about one sentence about praising that industry.
Yeah.
Okay. I changed my mind about the industry, but what I wrote about, I didn't change my mind.
Okay.
Because I used them for some of the ideas I had when there was no scientific literature on them. But that didn't change my mind. My whole point is I started by humans were idiots when it comes to fat tails. Okay, particularly under modern structure because the way we present probability to them, and Kahneman like that. But the idea that humans should, I never had the idea that humans should avoid 1/n, should avoid mental accounting, should avoid.
I don't think you believe
exactly, that. Exactly. I never changed my belief. I never believed in the equity premium puzzle.
Sure.
On the contrary.
Sure.
So, but I found initially in the industry things to back up. Although, in the industry they believe, and people who hate tail options keep citing the industry.
Right.
Because in that very paper that I like for the convexity of the function, Kahneman, shows that people overestimate the odds. You see? So I praised that paper. I never changed my mind on the paper. You see? I never changed my mind. I said it's completely wrong. It's only because you're clipping the tail.
Right.
That it shows that the missing tail shows in the probability jumping up.
Well, let me ask generally then, are there any big things in the Incerto that you've changed your mind about? Important things?
Nothing beyond a sentence.
Okay.
Okay. Yeah. So far, I've corrected a lot of sentences here and there. Like I've removed that sentence. I said something about Tetlock that I qualified. I say, okay, when he said his study is saying that that forecasting, people can't forecast. That's the industry was okay, but not the consequences that he drove it to weird conclusions. You see, so I kept taken from the industry that people can't forecast very well. We can't forecast very well, but they never went the next step, that you build a world where your forecasting doesn't matter, and or you have payoff functions that are convex, that where forecasting errors actually fuel expectation. In other words, the payoff improves from that.
All right, well, let's talk about forecasting. So I've got some questions about forecasting, and then about the precautionary principle, then war, then pandemics.
Okay.
So if you had to boil it down, how would you describe the substantive disagreement between you and the broad intellectual project of super forecasting? Is it just about binary versus continuous payoffs?
Yeah, there's one thing. First of all, it's the quality of the project, aside from the discussions. They didn't understand because I got a bunch of people involved with me, and the replies, our insults. You see, so the first one is binary versus continuous. Okay, and I knew that as an option trader, that the naive person would come in and think an out of the money binary option would go up in value when you fatten the tail. In fact, they go down in value when you fatten the tail, because a binary is a probability. So, I mean, just to give you the intuition, if I take the Gaussian curve, plus or minus 1 sigma is about 68%. If I fatten the tail, exiting, in other words, the probabilities of being above or below, actually they drop. You see? Why? Because you have the variance is more explained by rare events. The body distribution goes up.
Yeah, the
So you
shoulders
have more-
narrow.
exactly. You have more ordinary because you have high inequality. And the deviations that occur are much more pronounced.
Right.
Okay. So, and that we know. So in other words, you're making the wrong bet using binary options or using anything that clips your upside. That we knew as option traders, and rookies usually, or people who are not option traders, sometimes PhD in economics or something, they always express their bet using these, right? And we sell it to them because it's a net of two options. So, and there's a difference between making a bet where you get paid $1 and making a bet where you get paid a lot. And in Fool by Randoms, I explained that difference by saying that I was bullish, all right, the market, but I was short. How? Well, I was bullish in the sense, what do you mean by bullish? I think the market had higher probability of going up, but it's the expectation of being short is bigger. So these things, don't translate well outside option trading. And of course, these guys don't get it, okay, in forecasting. That the other one is the sub-select events that you can forecast but they're inconsequential. You see,
They're very small, restricted questions.
they're inconsequential. And also they're events. There's no such thing as an event. Like, for example, will there be a war? Yes or no? I mean, there can be a war, it could kill 2 people.
Right.
It could be a war, it could kill 600,000 people.
Yeah.
So in Extremistan, that's the one thing, one sentence Mandelbrot kept repeating to me. There is no such thing as a standard deviation in Extremistan.
Yeah.
You see, so you can't judge the event, by saying, oh, there's a pandemic or no pandemic.
Right.
Because the size is a random variable. Let me give you an example. Right. If there were, if you have, a scale, that's the idea of having scale-free distribution versus on scale. The ratio of people with 10 million over people with 5 million is the same as the ratio approximately 20 million over 10 million.
Mm-hmm. This is a Pareto.
Sorry, that's a Pareto. It's almost how you define it. Mm-hmm. But look at the consequences of that. The consequence of that it tells you that there's no standard event.
Right. There's no typical event.
Exactly. No typical event.
Yeah.
You cannot say the typical event. No large deviation. So to give you an idea, if I take a Gaussian, the expected deviation above 3 sigma is a little more than 3 sigma. And if you take 5 sigma, it's a little more than 5 sigma, right? It gets smaller. It's above 0 sigma, it's about 0.8 of a sigma. As you go higher, it shrinks. It's like saying, what's your life expectancy at 0? It's 80 years old. But at 100, it's 2 years, it's right. 80, 2 additional years. So as you increase the random variable, so whereas in Extremistan, the scale stays the same.
Yeah.
So the expected life, if we were distributed like company size, the expected company, as I said, what's the expected company higher than was 10 million in sales? 15 million. 100 million sales, 150 million, the average. 2 billion in sales, 3 billion, all right? So it's the same, it's like saying, oh, he's 100 years old, he has another 50 to go. How many? He's 1,000 years old, another 500 to go, okay? You can't apply the same reasoning with humans. We know what an old person is. Okay, because as you raise that number, things shrink. For Extremistan, as you raise that number, things don't shrink. As a matter of fact, and proportionally they stay the same, but in absolute they explode. Okay, so this is why that explosion tells you that there's no standard large deviation. So, and that was Mandelbrot's sentence, and just looking at the world from that standpoint, that there's no characteristic scale changed my work better than a crash of '87, because now I had a framework that is very simple to refer to, and they are probability basins. So this is why I learned a lot, working with Mandelbrot, and people weren't conscious of that stark difference, like operationally. Hence I wrote this book, Statistical Consequences of Fat Tails, and this is why I dedicated the Black Swan to Mandelbrot, based on that idea, that characteristic scale that I explained in the Black Swan. If you use that, then you have a problem with forecasting. You see, because it is sterile in the sense that what comes above has a meaning. See, is it higher than 10 million, higher than 100 million? It has a meaning. So this is where I've written another thing about forecasting, a paper, and I think we insulted Tetlock only because it's good to insult people who do such work, and also only insulted him because he spent like 5 years, that's why I call him the rat. Someone stabbing you in your back. So we explained that, and I called it, what did I call it? On the about a single forecast, point forecast, right? On why one should never do point forecast for a fat tail variable. What was the title of the paper?
Single point forecasts for fat tail variables.
Yeah, but I forgot what was the beginning, on the inadequacy or something. And in it, I wrote it with Chirillo and Yanir Marian, who were then active on COVID, because we did the data. We published in Nature Science and Nature Physics paper on distribution of people killed in pandemic. And guess what the tail exponent is?
It's like less than 1, isn't it?
It's half. Yeah, it's less than 1. It's like the Levy
infinite mean.
Yeah, it is actually clipped, not infinite mean. With some transform becomes infinite mean, but that is the same with wars.
Yeah, because you can't kill more than 8 billion people.
Kill more than a population, but it tracks for a large part of it. And if you do a log transform, then it's very robust. Anyway, so we were then involved in pandemics, and all these people saying, "Oh, he's super forecasting that how many people will be killed in the pandemic," right? And say, "No, it's foolish to forecast, and it's even more foolish to critique someone's forecast. He misforecast, because 95% of the observation will be below the mean."
Yeah, it's crazy.
You see, so if you have it's exactly like my trading. If 98% of the time you lose money, you can't say, "Well, his forecast is going to lose money this year."
Yeah,
you get the idea. It's meaningless.
Actually, on that, it's funny to think that Winston Churchill probably would have had a terrible Brier score. Like, he was wrong on all these questions, like the gold standard.
Who?
Winston Churchill.
Churchill. Yeah.
The gold standard, India, Gallipoli. That's one that's very close to home for Australians. Like, he was wrong on all these calls, but he was right on the big question of Hitler's intentions. So he was right in payoff space, like when it mattered.
Yeah, in payoff space it mattered. Yeah, he was wrong in the small. It's like you lose a battle and win the war.
Yeah,
it's like reverse of Napoleon.
Yeah,
Napoleon was only good at winning battles.
Okay?
Yeah, and he won. I don't know if you numerically look at how many battles he won.
He did pretty well.
He did well, except for Waterloo.
Right. The reverse Churchill.
Yeah, the reverse Churchill, and he's hyped up because they'll say, "Look how many battles he won." They were insignificant, maybe compared to the rest, and he was, and after a while, actually, he stopped winning them. It became harder because people learned from him.
Yeah.
So there's one thing about frequency space is a problem, because in the real world you're not paid in frequency.
Right.
You're paid in dollars and cents.
Yeah. Reminds me of that anecdote in Filled by Randomness. The trader, who I assume is you, is simultaneously bullish on the market going up over the next week.
Yeah, that was the one I was explaining.
But also short the market.
Yeah, that was the one I was explaining. In frequency space, I'm bullish, and payoff space, I'm bearish. Right?
Yeah.
So,
but do these binary forecasts have some? I agree that the value is limited, but don't they have some value? Like, I feel like if someone
I haven't seen many functions, because it assumes that you get a lump sum. I mean, for elections, they're binary, and there's another bias that I wrote a paper on about how to value election, how to integrate the variance in the price. But you don't have a good understanding of how to translate binaries into real world. And then we discovered another thing also with the binary. In a fat-tailed variable, if you want to get the exact probability, you see, it doesn't match the payoff. To give you an example, let's say that I have I'm good at forecasting the rate of growth of COVID. Okay, if you cannot translate that into how many people will be killed, because the rate of growth is the rate of growth. You see, if you have to translate it the number of people, you take the exponential of the rate of growth. You see, WT equal W0 ERT. Okay. And a small error in R, it can be thin-tailed, but if it's exponential, WT will be Pareto. You see, so you can have an infinite expectation on W with a finite expectation in R.
Right.
This is the problem. We tried to explain it in that paper. It didn't go through. So now what we discovered also later on, and this also applies to something what I call the VAR-CVAR dilemma, is that people thought we were good at value at risk, but not good at CVAR. Value at risk is saying, okay, you have within 95% confidence you won't lose more than $1 million. And I thought it was flawed, because that's not the right way, because conditional on losing more than $1 million, you may lose 200.
Right.
Okay. And so that remaining 5% is where the action was. But someone pointed out in a discussion group, or discussing the answer to Tetlock, and then mentioned that my application of that exponential transformation also applies for value at risk. Because he said, if you want to get the probability, the probability is distributed in thin-tails.
Because it's bounded between 0 and 1.
Exactly. It is thin-tailed.
Right.
Okay. It's a frequency. It's like a bet. It's random variable. This is why they have Ryer score, all that thing.
Yeah.
But then the transformation of that probability, okay, outside the Gaussian, okay, you have the inverse. You see, you want to go from a probability to X, rather than if you get F for probability. You see, that transformation, of course, is a concave convex function.
Right.
So it is explosive.
Okay.
You see.
So Nassim, for comparing your approach, I guess, extreme value theory, to
not extreme value theory.
Okay, sorry.
So, yes.
Okay. Comparing how you think about forecasting, or the impossibility of forecasting, to the super forecasting approach, how important is it as evidence, the fact that you have made a lot of money, and as far as I can see, there are no fabulously rich super forecasters?
Yeah, well, I always said something, that people good at forecasting, like in banks, they're never rich. I mean, we can make them talk to customers, and then customers remember, oh yeah, he forecasts this. But the there's another thing I want to add here on the function. If you take a convex function and you're betting against it, and we saw that we were doing Ruri in the same week we had a fight with Richard Taylor. So I showed something that I showed you in Ruri.
Yeah.
That you could, if you have a function, let's say that you're predicting volatility, right? And you're an option trader, and you're that was a VIX thing, and the volatility comes steadily, all right? You're gonna break even, all right? So in other words, you're let's assume that the level of volatility you break even. Now, if volatility comes unsteadily, you lose your shirt. I mean, you can move up the expectation by showing that, hey, you're predicting steadily and you make $1. But the volatility comes in lumps because the way you can express a bet against volatility is going to be nonlinear.
Mm-hmm.
If it comes in lumps, it comes the other way.
Mm-hmm.
So I said, okay, I'm 30% overestimating volatility and I'm making money. All right. He is buying volatility 30%. He's selling volatility, with a big discount and losing money. So this is where I take that function, and the function is you have you break even at 1. So you have 5 1 and 2 zeros, you make money. But if you have 6 zeros and 1 5, you lose your shirt.
Mm-hmm.
In squares. So we realize that. That's my think about. There's no. I've never seen a rich forecaster.
So if it came to light in a few decades' time that super forecasters had been doing really well, not blowing up, would that update you in favor of super forecasting?
We're saying ifs. Okay, let me see. I mean, I don't like these conditionals, right? So when you see super forecasters find a way to make money outside of being paid, to forecast, but like the function makes money, then it'll be very interesting.
Okay.
But I think that in the real world, we view this thing differently. You cannot isolate the forecasting from the payoff function.
Right.
So this is what my central problem is. And we tried to explain it to Tetlock. I even brought my friend Bruno Dupier. Somehow, Kahneman invited us to lunch. Actually, I ended up inviting, but said, let's have lunch. With Tetlock, he wants to discuss his super forecasting thing. I brought Bruno Dupier, who's a friend of mine, and he's a guy who has one paper, the most influential paper, I think, in all of derivative history. One paper, nothing else. And it was published in a magazine called Risk Magazine, all right? The guy's, to talk about it. He figured out, of course, quickly the difference between binary and vanilla and stuff like that. Anyway, so we had lunch. We realized they don't. I mean, Danny doesn't make claims, but Tetlock didn't even know what we're talking about, right? So, but there's something. How do I know if someone understands probability? They understand probability if they know that probability is not a product; it's a kernel. It's something that adds up to 1. All right.
Mm-hmm.
So whatever is inside, okay, cannot be isolated. It's a kernel.
Okay.
You see, it is a thing that adds up to 1. It's like saying the densities are not probabilities, but they work well within a kernel. We even had, at some point, people using negative probabilities. Just like in quantum mechanics, they use negative probabilities. And smart people understand that, yeah, you can use negative probabilities because it's a kernel. Okay, the constraints are not on the inside. The constraints say are on the summation, on the raw summation.
Right.
So when you say what is a kernel, therefore what are these properties? Okay, completely different. So you should look at what you're doing with probability. It's by itself doesn't come alone. So you're multiplying within an integral p of x with some function g of x.
Yeah.
Okay. P of x by itself has no meaning.
Yeah.
All right. G of x, all right, has some meaning. Now, if you're doing a binary, G of x is an indicator function. If x is above 100, 0 or 1, whatever, however you want to phrase it. Or it could be continuous, could be convex, could be concave, could have a lot of other shapes. And then we can talk. But talking about probability itself, you can't.
Yeah. You can't separate P of X and talk about that by itself.
Exactly. You can't talk about that by itself.
Yeah. That's the whole point of a probability density function.
Yeah.
It's density, not probability.
Yeah. For the mass function, it may resemble the probability for the frequency to be there, but it's just like something that has one attribute that it's a derivative of something that's never decreasing, and a function that is never decreasing and goes up between 0 and 1. So it's a derivative of a function, right? Because you reintegrate to use it. So that's the way you got to look at it.
Yeah.
So, and our option traders don't talk about probabilities. We talk about the value of the option. And the other option is like that part of distribution is valuable because you get a continuous payoff there.
Yeah. I've got some questions about the precautionary principle. So I want to stress test it with you or explore its application in practice. So I want to get your take on this critique of the precautionary principle. So the critique would be something like, it's possible to tell a story that all sorts of risks might be multiplicative systemic risks, and ultimately policymakers need to prioritize between those risks because contingency planning can be...
I believe in survival. So if you don't take it seriously, society doesn't survive.
Okay.
I just want a structure where those who don't survive don't bring down the whole thing.
Okay.
Because I think that the two things, the precautionary principle as understood, and there's what we call the non-naive precautionary principle.
Yes.
It has restrictions on what you got to have precaution about. Because a lot of people couldn't get it why are we so much against technology? We're not against technology. We're against some classes of engineering that have a reversible effect, and it was a huge standard error. And when I discussed on the podcast or the probability book, whatever you want to call this, with Scott Patterson, discussed the Mao story. What caused a great famine was trying to get rid of sparrows.
Sparrows?
Yeah.
Okay.
And then they killed all the sparrows, or they tried to kill as many sparrows as they could. And sparrows eat insects.
Right.
So they had an environmental problem with insects proliferating on the strain, and they didn't see it coming. All right. Now you say, okay, this is a case that's clear cut of disrupting nature at a large scale, you see, and something we don't quite understand. This is exactly what our precaution is about, except that we added multiplicative effects.
Yeah.
Like we don't exercise precaution on nuclear. This is why we're trying to, the way I wanted our precautionary principle to work is to tell you what is not precautionary. And for us, nuclear was not precautionary. Why? Because you can have small little reactors, and that one explodes in California doesn't impact one in Bogota.
The harm is localized.
Exactly. It's localized. So unlike pandemics.
Yeah. So to focus on technology, my understanding is that you wouldn't seek to apply the precautionary principle to the development of a technology that could pose systemic, irreversible risks just to its deployment. But because otherwise you would be going back and like setting fire to Mendel's pea plants because that knowledge could ultimately lead to GMOs. So there's obviously got to be a line.
We're against implementation of GMOs in nature. We're not against research about whether you can modify something.
Okay.
But you can't stop research. You can't. People, can do research in that building.
Yeah. Got it. So applying that to artificial intelligence, obviously, as the technology currently stands, it doesn't warrant application of the precautionary principle because it doesn't impose systemic harms.
Yeah.
If we got to the cusp of the technology being able to recursively self-improve, which the most plausible way that would happen is that we could use AI to automate AI research itself.
I have problems with discussing AI in terms of precaution because I don't immediately see anything about AI, why you should stop AI, that it will self-reproduce, given a robot cannot climb stairs. So you're afraid of, now you're afraid of robots, scared of robots multiplying and becoming a robot colony that would take over the world. I mean, these things are a stretch of imagination. We have bigger problems to worry about.
I don't think most people who think about AI risk view robotics as a constraint.
So what is
because
technology would the whole thing would become risky as technology becomes autonomous.
Right.
So in other words, that's my understanding that's what they're worried about. Okay, and it becomes autonomous. It has to, first of all, you can shut down your computer, right? And it no longer impacts our life here. You know, it can't hit the water because it's down the computer. The other one, for it to be systemic and taking over the whole planet,
mm-hmm.
the information systems. I mean, it's very strange that people who couldn't understand the GMO threat are now obsessing over AI because it tends to surprise them when they ask it a question. It tends to be, if you're surprised by AI, you have a problem.
Okay.
It means maybe that's for me an intelligence test to figure out what AI can do or cannot do.
Okay.
There's a lot of things it can do that helps.
Okay.
But for it to become a how can I autonomous? In other words, a colony of just like humans, like biologically equivalent to humans. You need you have so many steps to make.
Yes, but all that needs to happen as the first major step is it needs to automate AI research itself. And then as soon as it can make itself smarter through recursive self-improvement, all the other problems like robotics become much easier to solve.
Okay, let's see if it can do that.
Okay,
Right,
but if it could,
all right, yeah.
If it could,
let's worry about it. Then you put constraints. You can't put constraints ahead of time.
Okay.
On our research, you got to worry about an event happening.
Okay.
I mean, you got to see. We're talking speculatively.
Okay. One quick final side note on AI. A lot of people have remarked on the fact that LLMs haven't produced any original scientific insights.
Yeah.
And that may be because they're fundamentally Gaussian. Have you thought about?
No, it's not. That's not the reason.
Okay.
It's because they are. They may actually produce insight because of the randomizing stuff, and may make a mistake one day.
Right.
But so long as they don't make mistakes, just representing what's out there.
Yeah.
It's a probably weighted thing.
Okay.
As a matter of fact, it's the reverse of scientific research, because how does LLM work? It works at reflecting what makes sense, all right, probabilistically. So I try to trick it by asking it. You saw on Twitter in the beginning, you say, okay, how am I going to trick it? Because that's, if you know how it functions, and again, thanks to my genius friend Wolfram, I got this blog post he sent me. I read it, and I got the book. Said, okay, now I know it works. All right, it works by probability matching, by the way. All right, it doesn't give you the same answer all the time, and it's not going to do all the homework. So it doesn't have to connect the pieces directly. So use probabilistic methods. So that's what it reflects the consensus. So I asked it during the Congress of Berlin. There was a war between the Ottoman Empire on one hand, and then you had Greece on the other hand, among other allies. And there was a fellow, Kara Theodori, who was the father of the mathematician Kara Theodori, who was representing, someone there. Who did he represent? They said, oh, he's a foreign affairs minister of Greece. You see? It's not like a search engine giving you facts. It is using probabilistically how things occur together. He has a Greek name. Therefore, in fact, he was representing the other side, the Ottoman Empire.
Mm-hmm.
As a matter of fact, it was I think the Victorian days that he said, meeting with a representative of the Mohammedan world. It was an article in the Times, and his name was a Greek name. I think either Constantine Karatheodori or his son is Constantine, whatever. So I asked ChatGPT, made that mistake. So how do you make money in life? How do you really improve? How do you write a book? Think people didn't think about. Because if you're going to start a business that makes sense, guess what? Someone else thought about it. Okay.
Mm.
I think something, and ChatGPT is designed to tell you what makes sense based on current information.
Right.
Not look for an exception. There may be a possible modification. I don't know. To make ChatGPT only tell you what makes no sense. All right. and that would hit one day. But it's like our usual adage at Universa is, if you have a reason to buy an option, don't buy it.
Yeah.
Because other people will also have the same reason.
Yeah.
Okay.
Yeah.
So it's the same thing with starting a business. You're not going to make money on a business that makes sense.
Yeah.
Because a lot of people have tried it. Okay, maybe some pockets here and there. People have tried it. So the idea of ChatGPT coming up with genuine insights, okay, is exactly in reverse of the way it was modeled.
Mm-hmm.
And I, like everyone, it was vague for me until I saw the book by Wolfram, but a couple of years ago, 2 summers ago or last summer. It was the guy is very clear. He thinks like, he's very systematic and extremely intelligent.
Yeah.
I never met anybody more intelligent than him.
Yeah. I did a 4.5-hour podcast with him last year.
Yeah.
In Connecticut, and it was one of the more surreal experiences I've had.
Really, the guy is. You write down the formula, he gets it right away. He understands things like effortlessly. Yeah,
and his intellect isn't domain dependent. He can apply it across all aspects of his life.
Yeah, he had. I mean, I don't know. I don't want to.
But like he thinks about business really well as well.
He has a business.
Yeah, yeah.
But he's regimented, right, in the way he operates
and collects data on himself. And
sorry,
the way he collects data on himself.
He's. But anyway, so he's. I mean, I enjoy hiking with him.
Yeah.
Once a year. And anyway, so thanks to him, now we have an idea how these things work.
Mm-hmm. Okay.
It was clear. I mean, maybe there's some other text, but if I need a text, I'd rather read his treatment.
Yeah.
Because of the way I got used to thinking, and also because haven't seen the quality elsewhere.
Yeah. It's a great book. His primer on LLMs. So Nassim, I have some questions about war, some questions about COVID, and then we're finished.
Yeah.
So one of the deepest things I've picked up from you in recent times is the concept of the shadow mean. And I guess the intuition here is that we have some historical data for some phenomenon, whether that's market drawdowns or deaths from war or deaths from pandemics. And those data can appear to follow a thin-tailed distribution, but it's naive to assume that the process that's generating them is actually thin-tailed, because in the background, behind the curtains of reality, it could actually be a fat-tailed process that's generating the data. It's just that it takes a really long time for extreme events to show up. So fat-tailed distributions can masquerade as thin-tailed ones. And bringing this to statistical moments, the mean of the data we've observed is better thought of as the sample mean. And you have this approach where you work out what you call the shadow mean, which I guess is equivalent to like the population mean. That is the mean of the process that's actually generating the data. And you've done this for warfare, and I want to talk about that specifically, but just first generally, for others who may want to explore this approach, can you outline the basic steps in your process? Is it number one, estimate the alpha, number two, plug-in estimation?
Yeah. So let's explain to the viewers or listeners, what do I mean by shadow mean? Let's take a one-tailed distribution.
Mm-hmm.
Okay, you have visibly in a sample of 30 observation, you're not going to get events that happen less than 1% of the time.
Mm-hmm.
You agree?
Yes.
So for a Gaussian, it's not a big deal because these that happen less than 1% of the time have less impact on them. It probably gets increasingly smaller, so it doesn't matter much. So with a small sample, you don't have a big shadow mean effect. Actually, with a Gaussian, it has to be a one-tailed Gaussian, so a low variance like normal, right? Like height, okay?
Yeah.
So you observe a bunch of people and you have an idea what average height in town is, okay? Now, when we talk about things that are open-ended and fat-tailed, okay, visibly, most observation will be below the mean.
Mm-hmm.
So when you compute the mean, it's going to be biased down.
Yeah.
From what they call empirical observation.
Yeah.
So the empirical distribution is not empirical. And that's what is central for us.
Yeah.
So I take the S&P 500 and you can figure out that if you want to stress test it over the next X days, taking the past 10 years low, the past years, the worst deviation past 10 years is not representative because of insufficient sample as you go further in the tail. You take industries like biotech, for example, it is a heavy-tailed industry. So what you observe is less than, I think I wrote it in the Black Swan, the observed mean underestimate the true mean.
Mm.
Whereas for insurance, it overestimates the true mean.
Right.
For banking. Because one is to the right, one is to the left. So I looked at what has a positive shadow mean and what has a negative shadow mean. If you're selling volatility, you have a shadow mean that's going to be way lower than your observed mean.
Mm-hmm.
But if you're talking for wars, even without survivorship bias, which is another story, we have a process that's vastly nastier than what we observed.
About 3 times nastier.
Okay, 3 times nastier, yes. So in other words, the historical process underestimates the true process.
Mm.
And we published we published about the shadow mean in various venues. We have a paper in Physica A on wars, but we applied it in quantitative finance to Operation Lost.
Mm-hmm.
I published it in a journal called Quantitative Finance, and we applied it to other domains. But that's an idea that I wrote about in the Black Swan. But tell me, where's the invisible? Because visibly, by definition, the 100-year flood is not going to be present in 5-year data. Okay?
Mm-hmm.
So you have a shadow mean if you limit it to 5 years.
Yeah. So the other big innovation of the work that you did on war was this concept of inter-arrival time.
Mm-hmm.
And if I remember correctly, the waiting time for wars with deaths above a threshold of 10 million people is a bit over 100 years.
Yeah.
And that means that because we haven't observed any, like the last conflict with deaths of more than 10 million was World War II, nearly 80 years ago now. But we can't infer from that violence is declining.
Can't say violence is declining. Plus, another thing that we discovered that's very robust is inter-arrival time has an exponential distribution. Like a poisson, the inter-arrival time of poisson is, it means it's memoryless.
Right.
In other words, if it arrives on average every, say, 100 years, and then we haven't had one in 100 years, okay, you don't say, oh, it's coming. It's memoryless.
So you wait another 100 years.
The expectations stay the same.
Yeah. Yeah. So what structural explanations do you think are generating the fat-tailedness of war? Is it just the development of increasingly destructive technologies, and then maybe also some globalization and the fact that violence can spread mimetically?
I don't. I mean, I looked at the data and reflected the data. Violence did not decline. I did not put my concerns, and my concerns is that in the past, to do what's being done in Gaza now required much more. So we have a lot more destructive. The ability, I mean, to kill is greater. In the past, it would take a long time to kill, so many people.
Yeah.
So you have to do it manually.
Yeah.
And now we industrialize the process, which is very sad.
Yes.
And then I've started branching out now to foreign policy, realizing that effectively there's some things in that SJD, Society of Judgment Decision Making, when they analyzed the Vietnam War, and there are a lot of good things in that industry, and all the biases. You realize that we have the United States, most dynamic country, very vital, was completely incompetent State Department. So you realize the decision for war. I mean, think of Afghanistan, how naive it is not to figure out what's going on. So they're going to make mistakes, of course, more mistakes, of course. And these alliances, like you back up, not understanding consequences. So it's sort of like Mao's sparrows. You back up Bin Laden, not realizing that you helped Bin Laden, you built a machine that will turn against you.
Right. It's like the Hydra.
Like?
The Hydra. We cut off a head and we'll grow back.
No, but they created, so if a interventionist foreign policy on the part of the United States, and then spreading democracy or stuff like that is actually more dangerous than just isolationism. So the culture is very different today.
Right.
Which is why, outside of our statistical work, I have to say that there's this incompetence dressed in sophistication that makes the world more dangerous.
So then if we move back through the historical data, the wars become less fat-tailed as you move into the past?
No, the fat-tailedness is the same, what we call the scale.
Mm-hmm.
The alpha doesn't change, the scale changes.
So I think one of the things that you and Professore Pasquale Cirillo found was that in the past, death counts were exaggerated both because conquerors and victims had incentives to exaggerate. Obviously, the conquerors want to appear more intimidating.
No. I made this comment later on after looking at the data, because when we analyzed past wars, we try to figure out a robust way to look at the structure of the random variable by taking for every war different accounts and then randomizing between the high and the low. Say Algeria's war, the French had 280,000, for example. The Algerians had 1 million. Since then, everything had been revised. So we took both numbers and randomized. So we created 150,000 histories between all the numbers that we had with permutation from within the high and the low estimate. And we figure out that, boom, they all give the same alpha.
Right.
So but the motivation was that people lie about numbers.
And is that true?
And ours is to remove the effect of different estimates of them or their enemies, you see?
Okay.
So aside from that, in a non-probabilistic way, I myself observed that a lot of people like to exaggerate their killings. Yeah. Like Genghis Khan, because it was optimal. Mm-hmm. You don't have, if people think that you're going to kill a lot of people, they won't oppose you. So, which is why you do a lot of stuff for show. Yes. Yeah, a lot of devastation for show.
Yes. That makes sense. Victims exaggerating their suffering was less intuitive to me, but then I remembered Tom Holland's work or Renee Girard's work or even your treatment of Christianity and Skin in the Game. I realized what makes Christianity unique is the valorization of the victim.
Christianity and Shiite Islam.
Right.
Only the two religions that that have this glorification of victimhood,
Yes.
which is Christianity and Shiite Islam.
Yes.
Shiite Islam, when they have a martyr, like, and there's still been after the murder of Hassan and Hussein, 1,300 years of mourning or stuff like that, a glorification, basically for just being killed.
Yes. So I was wondering if the glorification of victimhood, if the spread of Christianity is maybe what was driving the exaggeration of death counts on the victim side.
I don't know. We don't have good records of what happened in the period right before Christianity dominates, simply because we had a big transition, and history is written by the winners, of course, by the Christians.
Yeah.
So we don't have a clean record of what happened before, but we know that there are some purely invented, fabricated series of events of martyrdom in what's now North Africa, and Southern Mediterranean, and the Roman Southern Mediterranean.
Yeah.
So we know a lot of them existed, and we know a lot of them, as he says, didn't exist, or exist under the same story in 17 different places,
right,
or 7 different places.
Right.
So we know that either existed too much or did not exist.
Yeah. Yeah. So one of the implications of your work on war with Pasquale is that because of these inter-arrival times, we really should wait about 300 years without seeing a conflict of the scale of World War II.
Yeah, if you had to wait 300 years, then you'd say, oh, the distribution has changed.
Yes, then we could say...
But we have had no information statistically from the past 80 years.
Yeah.
And that was the thing about Pinker thinks that the world has changed. And he couldn't understand our insults. Just like Tetlock, they couldn't understand the statistical claim against that.
Yeah. So you think that, I mean, it's possible that the data generating processes could change. It's just that we haven't seen anything that would overturn the null hypothesis.
That's exactly the point.
Yes.
That's one way to look at it. I don't like the null hypothesis story.
Yeah.
Because that's mostly for applied statistician working in the medical lab, all right, or psychology department. But that's pretty much. But the gist of it is there.
That's the intuition.
Yes.
Yes, and so we have no statistical grounds on which to say violence has declined.
None.
Yeah. It's,
and we didn't even go to the second step by saying it has increased, which is what I saw. But I said I don't want to make that point statistically.
Yeah. Well, it's super interesting and important work. I want to talk about COVID. So, actually, sorry. One maybe. Can I just ask you one technical question on the war stuff before we move on? So, I'm not sure if this is an interesting question, but let me test it on you. So generally, how much does it change the conclusion of analyses like yours with Pasquale on war if you impose soft ceilings like the 8 billion deaths?
0.
Okay. Because you stress tested it for war.
No. That soft ceiling.
Yeah.
You mean is only an artifact.
Yeah.
Okay, to show that in log space it is a power law.
Okay.
But you have to go up to 5 billion doesn't make a difference whether it's ceiling or no ceiling.
Okay.
For both.
Yeah.
It doesn't make a difference because the ceiling is continuous. It's like a log function that turns the max into infinity.
Okay.
Okay, but as it only happens asymptotically.
Okay. All right. Yes, I want to talk about COVID. So in late January 2020, you wrote a memo with Yanir, a mutual friend.
Yeah, it started. And I mean, Yanir and I were concerned about Ebola before that.
Yes, back in 2014.
Yeah, we were obsessing over pandemic because I wrote on the Black Swan,
Yeah.
And it was picked up by a bunch of people in Singapore. So we were like all concerned about, the big pandemic because it would travel faster than the Great Plague.
Yeah.
So this is why we were very concerned when it started, and we wanted to invite people to kill it in the egg.
Yes. And you wrote this memo, which was then shared with a friend in the White House.
Yeah.
Can you tell me the story of that? And is there anything you can share that you haven't shared publicly before?
The paper by itself is meaningless because we would have written one in Nir and I separately. But there was no particular novelty to that idea.
Sure.
But when we started seeing what's happening in China, we realized that there was a problem. And then I started looking at ways to how do you mitigate something that's fat-tailed? You lower the scale. How do you lower the scale? By cutting off the distribution to parts.
Mm-hmm.
Okay.
Reduce connectivity.
And it's very strange that the Trump administration did not. They spent all this money, all right, on giving money, handing out money, all of that. It didn't hit them that you're most effective by having controls at the border, where you test people. I mean, that in the past we used to have very effective lazarettos where people were confined or quarantined. And now we can do it more effectively with testing.
Do you think your memo with Unir is what convinced the White House to close the borders to China?
I don't care less about the White House.
Okay.
There's something that disgusts me about the Trump administration. I don't want to. You just do your duty and you move on.
Do you sense that governments and policymakers, say in the US, have gotten any better at thinking about how to deal with tail risk?
No. I think, if anything, their effort to deal with risk increased tail risk because you end up with people like Cass Sunstein and these pathologizers, I call them. They make you stupid for worrying about things because their textbook tells you they shouldn't worry about it. And they don't understand fat tails. Once you understand fat tails, things become very easy. You start thinking differently about AI, differently about other things. You see? You tell me, I'll tell you, yeah, once AI starts multiplying, let me know, right? And stuff like that. This is my department, fat tails, and precaution requires fat tails.
Yeah.
I mean, you can have precaution at different levels, but the one we're concerned with at a higher micro level requires fat tails.
Do we need any new social institutions to better deal with fat tails?
I have no idea.
Okay.
I mean, at this point, I'm too disgusted with these bureaucrats and the way they handle on both sides.
Via negativa is
the way they exactly. I mean, you want a simpler world.
Yeah.
You create a complex world, you put institutions that make it more complex. Sort of like U.S. foreign policy. You go to Afghanistan, then you have to handle the government of Afghanistan. So it's like you get involved into a series of feedback loops you never thought you'd get into.
Yeah. So, Nassim, I'm finished with my main questions. I had a few random questions.
Let's continue. Yeah.
It's just a random sampling of different things.
Because I don't do podcasts and interviews. So, anyway.
Well, I very much appreciate you speaking with me. So, okay, what's the biggest thing most people in social science get wrong about correlation?
That's an important question. They don't know what it means. There are SGD people who really think that experts have a problem, and there are good results there, and they ask the people to do the regression.
Mm-hmm.
What does it mean? And they can explain their own results. They know the equation. They couldn't explain the graph. How much this represents of that. So there are a lot of incompetence in social science, and they use metrics they don't understand. A lot of people thought correlation was an objective thing. It's a measure that depends on subsample, and then has a very limited meaning. And also, they don't realize that when you do visually, that correlation of 50 is not halfway between 0 and 1. It's much closer to 0.
You have this saying, so people are familiar with the phrase correlation isn't causation. You have this phrase correlation isn't correlation.
Yeah, exactly. I had a lot of Twitter fights with people, and that was fun because I didn't know that people didn't think of correlation that way. That's another thing. If you look in finance naively, you see that the effect of the mean of correlation, it appears to be say X and Y are correlated. Your expectation of delta X is going to be rho, sigma X over sigma Y, all right? Based on the time delta Y, right? You're linking, you observe the effect of X based on observation of Y. But for betting and decision making, it's not that. It's more like a factor that's something like rho square or 1 minus rho square, or like similar to the minus log of 1 minus rho square. So in other words, very nonlinear. In other words, low correlations are noise, and again, 50 is not halfway between 0 and 1.
Right.
And 1 is infinity. That's for decision making. And you put that into your either Kelly criterion or any form of decision making, and then you realize how much more I should bet on X knowing Y, or on something knowing some side information, and simplified. When I made a graph showing how it has this, how visually you can see it. You see, you can mutual information, which is an entropy measure, is vastly more informative. That's in a linear world. And now, as you go nonlinear, visibly, if you have a V curve, zero correlation and infinite mutual information. So there's that mistake with correlation, but there are other mistakes in correlation not well explored. I didn't go into it because I'm into cycling. I'm too lazy to go into it. But I showed that basically it's not. It's not. It's sub-additive. Okay,
Right.
to give an example, if I take a correlation of a row, it's not going to be a row in the positive. If you sum up the quadrants, positive, X positive, Y positive, X negative. If you sum up the quadrants, you don't get row, because visibly the mean shifts according to every quadrant. So it's going to be sub-additive in absolute terms, which is a problem. It tells you that subsampling, taking a correlation of subsample, doesn't give you a correlation of the whole. And that's not well known. And I wrote a paper. I don't feel like publishing it because the problem with referees is it's hard to get good referees. So on the last paper, we had a guy that's telling me, I'm substituting correlation with mutual information, and say, do you have evidence that correlation is a metric? You don't say you have evidence, scientific evidence that correlation works. It is a metric, right? By definition. So you can use it for evidence. So I said, okay, you got to give up on publishing too much because of contact with referees who are not sophisticated, unless you find the journals that have the good referees. So maybe I'll publish these results because the practical implication is monstrous.
Mm.
And maybe I'll put it here. I'm the second edition, third edition. I add correlation. Smart people get it. Smart people, but you have to know math to know that correlation is not.
Yeah.
What it means.
Right.
And then you regression. They do regression was an R square of 0.05.
And they think, anything above 0.5 is kind of celebrated in social science. I see,
but the problem is if you include model error, okay, it dilutes the 0.5 big time.
Right. It's crazy. I mean, there's just so much of social science is built on correlation.
And is so huge crowd. Plus the other thing is how to translate a result. Let's say that you see papers and you see a huge cloud. Okay, and it tells you, oh, look, IQ and education, or IQ and wealth. All right, okay, very good. Or IQ and income. First of all, it's wrong. Income is fat-tailed. IQ is by design thin-tailed.
So you can't regress them.
Yeah, but let's say we did that. They got a big noise. In other words, if you hire someone based on IQ, it's such a you get such a low probability in your favor for a sample of one. You need a lot of large numbers. They don't get it.
Mm-hmm.
So you should hire on no, because with such a weak correlation, the law of large numbers, okay, doesn't start acting till you hire, I don't know, a whole town or something. You see, you get the idea. So you're getting noise,
right?
So that metric is noise unless you have wholesale,
yeah,
because of visual variations.
Yeah.
So the way the law of large number works, I explore it here, even for thin tails, all right, is misunderstood. What I call the reverse law of large numbers. If you take a property, say how much hypertension is going to be lowered by this medication, all right, and reverse it and look at what are the odds of it working on your patient, you get a complete different answer from the one they think. Because on average it works, say 4 points, but some people it's going to be a lot higher, and so forth. So this is where the interpretation of the statistical claims that they're making, it can be messed up.
Right.
I mean, I saw it in the IQ. First of all, they don't know how to compute a lot of things, and they don't know how to read correlation, but also how they interpret it. Because tell them, okay, put a graph with a noise. And you see a graph and you realize, at the best of their claims, in these papers that show the effectiveness of using IQ, even, with the circularity, in fact, that if you're good at taking exams, you're going to have a high IQ, but you're also going to get a good college degree. And that helps your income in the beginning, right? We're not talking about wealth or stuff, so it's for employees. So even taking all of these, you look at the cloud and say, well, you know what? You can't use it for any individual hire. See? You need a batch.
Mm-hmm.
And then they start, there are a lot of other things in IQ that tells me that either these people, I used to think that they're mean, like, in other words, like a lot of race science comes from people being, having some kind of problem, all right, sociopathic problem. So I thought that, but I think no, they're just plain dumb. And then and you can see it in the real world. Think about it. If these people know anything, they'd go make money and then go continue doing psychology, but they can't.
It's very true. Okay, next random question.
Yeah.
Maybe you know the answer to this, maybe not, but historically, culturally, how do you explain the perspicacity of the Russian school of probability? What was in the water in Russia?
No, I mean, schools emerge when you start having norms and groups of smart people together. And there's a depth in a Russian approach to mathematics. But during the Soviet, they had to make themselves useful. Science had to contribute to society. So it can be remarkably practical, while at the same time there's that constraint. And I mean, a lot of it is French as well. I mean, when you look at the big results, okay, you always have you have a combination of, but I think the Russians have contributed the most to probability, followed by, of course, the French, and of course, the English school of probability is just like Galton. And all these regression, all these things that are bad come from this English school of probability. And usually they had an agenda. Like Galton wanted to prove that Irish were stupid by measuring the cranium.
Right.
And the linear regression, the hypothesis testing, the Fisher thing, all these are completely different from but there's one is probability, the other one is what we call standardized statistics. But you cannot go non-standard statistics without knowing probability. So we have a class of people who can only use Gaussian. And I have this theory that every single problem needs a new class of estimators adapted to the problem.
Mm-hmm.
Seems
like a pretty good heuristic.
Yeah. So if you don't know how to redo an estimator, how to redo the theory,
yeah,
you see, the only thing in common is a law of large numbers. That's it.
Right.
And you want to know what it applies to. So when you ask me something about the alpha, the law of large numbers sometimes works a lot better for the alpha than does for the mean.
Yeah, because the tail exponents follow a thin-tailed distribution, right?
It follows an inverse gamma distribution. And, and you get it if the process
which is
is
a
clean.
Specific type of thin-tailed.
Yeah. If you get it, if the process is clean,
yeah.
Okay, you have it's remarkable how quickly you get the alpha.
Yeah, that's cool.
I showed you at Ruri, reversed, try to get the means all over the map.
Yeah.
You get the alpha always within like.
Yeah, it's really neat. It's really neat.
Yeah. Standard error on the alpha is low.
Yeah.
Standard error on the mean is huge.
Yeah. Yeah. So you think Hayek's knowledge argument can't support prediction markets, and obviously Hayek argued that knowledge was consolidated through prices and arbitrage trading products, services, financial securities.
Yeah.
Is the principal difference there just that these things that Hayek was considering were continuous and that logic can't be extended to aggregating binary forecasts? Or what's the difference?
Hayek's idea is that it's explicit versus implicit. That for him, knowledge is not explicit, that it's implicit. The difference between knowledge that can be taught and formalized and knowledge that is embedded in society.
Mm-hmm.
And that one expresses itself through the manufacturing and then the end price. And why a systematized economy, you're systematizing something that is not explicitly lend itself to explicit phrasing is what harmed the Soviets. Okay, so I would not. I would not. I would say that this applies to probability the wrong way for you, which is that using a probabilistic model is trying to be systematic about things that are too rich for you to express them systematically.
Okay,
you see. So in other words, his knowledge is what's embedded in society, not what is formalized. Otherwise, the Soviets would have taken the formula and applied it.
Okay, maybe I'm too slow today, but so how does that preclude extending the knowledge argument to prediction markets?
Because we're not just talking about prediction. We're talking about functions of predictions.
Okay.
That are all embedded. And you can have what appears to you a bad predictor in frequency space, but the function turns out to be better.
Mm-hmm. Got it.
You see? And you don't know the functions. You don't know it's still systematizing something that should be.
Yeah.
You should look at the result of the process, not the exact replication of that process in a lab environment.
Yeah. Okay, I'll ask my last random question.
Yes.
So I know that generally you prefer mean absolute deviation to standard deviation. Why has standard deviation become such a traditional measure? Like historically, how did that happen?
Okay, because I think I discovered here a paper claimed by Fisher, I think.
Right.
Who found that in the Gaussian case, it's more efficient than mean absolute deviation.
Yeah.
Because again, to tell the viewers, a lot of people mistake one for the other. Standard deviation is the square root of the sum of the average sum squares. It's not, so it doesn't have a physical intuition.
Yeah.
It's what a standard deviation is. What is median is the average. So, for example, if you have the process, right, with all the observation at 0, and one observation at 1,000,000 for an average of 1,000,000, the standard deviation be 500 times mean deviation.
Right.
In the Gaussian world, it's about 25% higher, like square root of the usual story 2 over pi is mean deviation over standard deviation.
Got it.
So this is I would say that that's another basic thing that a lot of people, we wrote a paper, people don't know what they talk about when they talk about volatility, because they would use, we're talking about people who are practitioners and people who are students, PhD students in mathematics or finance, and then we asked them to try to interpret some kind of financial data where you're showing standard deviation, volatility, and then they would give you mean deviation interpretation.
Mm-hmm.
So
yeah, it's more intuitive than standard deviation.
Yes.
Yeah.
No. So there, and there's a wedge. Both of them. On the fat tails, the way I'm interested in the measure, not because of, to pick on practitioners who make mistakes, but because the ratio of standard deviation mean deviation is the best indicator of fat tailness.
Yeah.
See.
Yeah.
And for Gaussian, it's I said 25% higher. For Cauchy, it's infinite.
Yeah.
Not infinite. I mean, for something that has not Cauchy, anything with an alpha below 2,
mm-hmm.
it's going to be infinite.
Mm-hmm.
Because one is infinite, the other is finite.
Final question. Is there anything you can tell me about your next book, The Lydian Stone?
I have no idea what my next book, what shape it will take. For last 3 books, last 2 books, Skin and Game and this one, I had no conversation. I just finished the book.
Yeah.
And I don't like this. You got to write a plan. People get excited. They got bookstores, all that. I'm working now on really leaving good work. So next book has to do with time, scale, and probability.
Okay.
There's a lot of entropy stuff in it, but I'm at a point where I'm writing for myself now.
Yeah.
What makes the most fun?
That's great.
And there's nothing more fun than this, because an hour, 2 hours a day of math, you feel rested after that.
Yeah.
You see, whereas so I'm doing more math.
Great. Well, I wish you much more math and much more enjoyment.
Yeah, but I'm not. I don't want to be identified, and I don't want my grades to say I'm a mathematician. I'm just enjoying using it for problems that are non-mathematical in nature. So it's not like I'm trying to improve the math. I'm using it, but math is fun and relaxing.
Yeah.
So this is why I like it.
Yeah. Well, Nassim, you've been so generous with your time. Thank you so much. It's been a real honor.
Thanks for inviting me, and hopefully next time we do a podcast, you reverse. You start with random questions and then you go to structure.
Okay, sounds good.
That's more Hayekian. Thanks. Bye, everyone.
Thanks, Nassim.